In 1988, Warren Buffett did something that looked boring. He spent $1.3 billion buying shares of a soda company. Not a tech startup, not a flashy IPO, a company that sold sugar water, Coca-Cola. People thought he was crazy. They said, "Warren, the best days of Coca-Cola are behind it." But Buffett didn't care. He saw something almost nobody else saw. He saw a money machine hiding in plain sight. Fast forward to today. That $1.3 billion investment now pays Buffett $816 million every single year. Just in dividends. He doesn't sell a single share. He just sits there, and every 3 months, Coca-Cola wires more than $200 million straight into Berkshire Hathaway's bank account. He gets back 63% of his original investment every year without lifting a finger. That's not a lucky break. That's a strategy. And today, I'm going to break down exactly why Warren Buffett loves dividend stocks, why he calls dividend growers his secret sauce, and how you can use the same approach to start building real wealth, even if you're starting with almost nothing. So let's get into it. Here's what most people get wrong about dividends. They look at a stock paying 2 or 3% a year and think, "That's nothing. I can barely buy lunch with that." And on the surface, they're right. If you invest $1,000 and get $30 back this year, it doesn't exactly change your life. But that's because most people are thinking about dividends like a snapshot. Buffett thinks about dividends like a movie. He's watching the whole story unfold over decades. See, the real power of dividends isn't what they pay you today. It's what they'll pay you 10, 20, 30 years from now. And this is where the concept of yield on cost becomes the most important number you've probably never heard of. Yield on cost means this. What percentage of your original investment are you getting back in dividends each year? When Buffett first bought Coca-Cola, the dividend yield was about 3.5%. Decent, not life-changing. But Coca-Cola raises its dividend every year. It's done this for 63 consecutive years. They call companies like that dividend kings. And because of those raises, Buffett's yield on his original cost is now roughly 63%. He's earning back almost 2/3 of his entire original investment every single year in cash. And Coca-Cola isn't even his only dividend machine. In his 2023 shareholder letter, Buffett pulled back the curtain on what he called Berkshire Hathaway's secret. He pointed to 2 stocks, Coca-Cola and American Express. He paid about $1.3 billion for each position back in the 1990s. And by the time he wrote that letter, those 2 investments alone were sending him more than $1 billion a year in combined dividends. Since that letter, American Express has raised its dividend by more than 91%. Just a few days ago, American Express bumped its quarterly dividend again from 82 cents to 93 cents per share. That means Berkshire's quarterly check from American Express alone just jumped to $141 million. He invested $2.6 billion total. And these 2 companies now pay him over $1 billion a year. Not from selling, not from trading, just from holding. That's the Buffett way. But let's go deeper. Let's look at Berkshire Hathaway's top 5 holdings, because the pattern is everywhere. Apple, Berkshire's biggest stock position, has doubled its dividend since Buffett first started buying shares in 2016. Today, those shares pay Berkshire over $291 million a year in dividends. Bank of America is another monster. Buffett originally bought preferred shares during the financial crisis in 2011, then converted them to common stock in 2017 at a price of $7.14 per share. Since then, Bank of America has nearly quadrupled its dividend. Berkshire now collects more than $675 million a year from that single position. Then there's Chevron. Buffett first bought shares in 2020. Since then, Chevron has raised its dividend by 32%. Berkshire now owns 122 million shares, pulling in about $835 million a year. On an estimated purchase price of $127 per share, that's a yield on cost of 5.4%. And it's only been a few years. Imagine where that number will be in a decade. Add it all up, and Berkshire Hathaway collects roughly $4.5 billion a year in dividend income from its stock portfolio. That's $4.5 billion flowing in without selling anything. That's the power Buffett has been building for decades. And here's what really separates Buffett from the average investor. He doesn't just collect those dividends and spend them. Berkshire Hathaway takes that incoming cash and redeploys it. New investments, new acquisitions, new opportunities. Every dividend dollar becomes fuel for the next deal. It's a compounding engine. The dividends fund more assets, which generate more dividends, which fund even more assets. Round and round it goes. Most people collect dividends and buy a nice dinner. Buffett collects dividends and buys entire companies. That's the difference between using dividends for consumption and using dividends for acceleration. And this isn't just old Buffett behavior. Even in the final months before he stepped down as CEO, Berkshire was still actively buying into dividend growers. One of the newest additions? Domino's Pizza. Over the course of 6 consecutive quarters leading up to his retirement, Buffett built a nearly 10% stake in Domino's, worth about $1.4 billion. And just weeks ago, in February, Domino's hiked its quarterly dividend by 15%, raising it to $1.99 per share. That's the Buffett pattern in real time. Find a strong brand with a growing dividend, buy a massive position, and then sit back as the payments increase year after year. He was doing this right up until the very last day he ran the company. So why does he love this strategy so much? Let me give you the 5 core reasons. The first reason is compounding. Buffett once said, "My life has been a product of compound interest." And he wasn't exaggerating. 98% of Buffett's net worth was accumulated after he turned 65. That's not because he suddenly got smarter at 65. It's because compounding needs time to turn into something massive. When a company raises its dividend year after year and you never sell your shares, the amount of cash flowing to you grows exponentially over time. It starts slow. That 3% yield becomes 5%, then 10%, then 20%, then 60%. The secret ingredient is time. Most people never give compounding enough time to work. Buffett does. The second reason is predictability. Buffett doesn't like surprises. He likes businesses that are boring, stable, and consistent. A company that has raised its dividend for 63 years in a row, like Coca-Cola, has proven something very important. It makes money year after year, no matter what the economy does. Recessions, pandemics, inflation, wars. Through all of it, that dividend check keeps coming. For Buffett, a rising dividend is proof that the business is healthy. The third reason is discipline. Here's something most people don't realize. When a company commits to paying and raising a dividend, it forces the management team to be disciplined with money. They can't waste cash on bad acquisitions or vanity projects, because they have to set aside money for shareholders every quarter. Buffett loves that accountability. It means the company is run by adults, not gamblers. The fourth reason is that dividends reduce risk. Think about it this way. If you own a stock that drops 20% but keeps paying you a solid dividend, you're still getting paid while you wait for the price to recover. That income acts like a cushion. It softens the blow during bad markets. And if you're reinvesting those dividends, you're buying more shares at a lower price, which sets you up for even bigger gains when the market bounces back. Buffett has lived through multiple crashes. He never panics. And a big reason is because his dividend income never stops flowing. The data backs this up too. According to S&P Global, the dividend aristocrats, those S&P 500 companies that have raised dividends for at least 25 consecutive years, have historically outperformed the broader S&P 500 with lower volatility over rolling 10, 15, and 20-year periods. Higher returns and a smoother ride. That's exactly the kind of math Buffett loves. The fifth reason is freedom. This is the reason that matters most for people like you and me. Buffett built a machine that generates billions in passive income. If you can build a portfolio of quality dividend-paying stocks that grows its payments every year, eventually, those dividends can cover your bills, your rent, your groceries, your car payment. That's what financial freedom actually looks like. Not a lottery ticket, not a crypto moonshot, just steady, growing income from owning pieces of great businesses. Now here's a piece of data that should stop you in your tracks. According to a study by Hartford Funds, 85% of the cumulative total return of the S&P 500 since 1960 can be attributed to reinvested dividends and the power of compounding. That means if you strip out dividends and only look at stock price appreciation, you're missing the overwhelming majority of where wealth actually comes from in the stock market. Most people are obsessed with finding the next stock that's going to double in price. Meanwhile, they're ignoring the engine that's responsible for 85% of all the returns in the market's history. Buffett isn't ignoring it. He built his entire empire on top of it. And the historical data goes even deeper. From 1930 through 2024, dividend income contributed an average of 40% of the S&P 500's total return on a decade-by-decade basis. In some decades, like the 2000s, when the market was basically flat, dividends were the only thing keeping investors above water. That's 10 years where stock prices went nowhere, and the only people who made money were the ones collecting dividends. Now, let me talk about something that's happening right now that makes this even more relevant. At the end of 2025, Warren Buffett officially stepped down as CEO of Berkshire Hathaway after more than 6 decades. Greg Abel, his hand-picked successor, has taken the reins, and in his first shareholder letter, Abel made something clear. The strategy isn't changing. The dividend-paying powerhouses in Berkshire's portfolio, Coca-Cola, American Express, Apple, Bank of America, Chevron, they're staying right where they are. Why? Because the most important thing Abel can do right now is simply sit back and let these dividend machines keep working. The dividends from these 5 companies alone make up about 70% of Berkshire's entire equity portfolio. These stocks are paying for themselves every few years with their annual dividend income. That's the legacy Buffett built, and it keeps generating wealth whether he's in the office or not. There's also something fascinating happening with Berkshire's cash position that connects directly to the dividend story. At the end of 2025, Berkshire was sitting on about $373 billion in cash and treasury bills. That's not a sign of fear. It's actually another layer of the dividend mindset. Buffett has always said he wants Berkshire to have enough cash on hand to survive any disaster and strike when opportunities appear. Those billions in dividends flowing in every year from his stock portfolio are part of what keeps that war chest growing. The dividend income gives him options. It gives him patience. It means he never has to sell a single stock at a bad time, because cash keeps arriving every quarter like clockwork. There's a lesson in all of this for you and me. You don't need to be a genius stock picker. You don't need to watch the market every day. You don't need to time your entries perfectly. You need to buy quality companies that pay growing dividends, hold them for a long time, and let compounding do the heavy lifting. Let me make this more concrete. Let's say you invest $500 a month into a diversified portfolio of dividend-growing stocks with an average yield of 3% and average dividend growth of 7% per year. In year one, your dividend income might be $180. Not much. But by year 10, it could be over $5,000 a year. By year 20, it could cross $25,000. By year 30, you could be collecting over $80,000 a year in dividend income alone, and you never sold a single share. That's the same principle Buffett used. He just started with more capital and more time. But the math works the same for everyone. The system doesn't care if you're a billionaire or a barista. Compound dividend growth rewards patience. So, what should you actually look for if you want to follow Buffett's dividend playbook? There are 4 things. First, look for companies with a long track record of raising dividends. Buffett's favorites have raised payments for decades. Coca-Cola, 63 consecutive years. American Express has been increasing aggressively. Look for dividend aristocrats or dividend kings. These are companies in the S&P 500 that have raised dividends for 25 or 50-plus consecutive years. Second, look for strong competitive advantages. Buffett calls this a moat. Coca-Cola has one of the most recognized brands on the planet. American Express has a premium customer base that spends 3 to 4 times more than the average credit card user. Apple has an ecosystem that locks in over 1 billion users. These moats protect the business and protect your dividend. Third, pay attention to the payout ratio. This tells you what percentage of earnings the company pays out as dividends. If a company earns $4 per share and pays $2 in dividends, the payout ratio is 50%. That's healthy. It means there's room to keep raising the dividend. If the payout ratio is above 80% or 90%, that's a warning sign. The company might be stretching to maintain its payments. Fourth, think long-term. Buffett bought Coca-Cola in 1988. That's nearly 4 decades ago. He bought American Express in the 1990s. He bought Apple starting in 2016. These aren't short-term trades, they're commitments. Here's the bottom line. Warren Buffett, the greatest investor who has ever lived, didn't build his fortune through day trading, meme stocks, or speculative bets. He built it by buying shares in strong, profitable companies that pay him more cash every single year. He let time and compounding do the rest. Berkshire Hathaway now collects roughly $4.5 billion a year in dividends from its stock portfolio. His Coca-Cola investment alone generates a 63% annual yield on what he originally paid. His secret sauce, as he called it, was never a secret at all. It was just too simple for most people to believe. Buy great companies, collect growing dividends, be patient. That's the whole game. If you're tired of living paycheck to paycheck, if you want to build something that actually pays you back, dividend investing is how regular people build generational wealth. You don't need $1 million to start. You need a plan, consistency, and time. Thanks for watching, and I'll see you in the next one.